Welcome back. Still watching Business Morning live on Channel Television. Now for the commodities market update, we have Dr. Adeshola Simoni, Senior Associate Financial Directors Company, join us via Zoom. Great to have you on the show. Good morning.
Good morning, Ladi. Thank you for having me on the show.
Yeah, so it's rate setting season, right now. And obviously, we know the central bank, MPC, started their meeting yesterday. Today, we're going to have a decision. What are you expecting?
Thank you for that question, Ladi. So this is the first meeting of the MPC this year, and it's also the last meeting before the general election. So it's quite significant, right? And the MPC, they are meeting against a backdrop of, in the domestic economy, high inflation. Inflation as of December was still at 21.3%. They are meeting against the backdrop of slowing growth. Q3 GDP growth rate slowed to, I think, 2.3%, down from around 3% in Q2. They are meeting against a backdrop of tighter financial conditions in the domestic economy. On the global scale as well, they're meeting against a backdrop of uncertainty in terms of global economic growth. The IMF has forecast that about a third of countries would experience a recession in 2023. They're meeting against a backdrop of global inflation, still relatively high global inflation, still relatively high interest rates in the global economy, as well as tighter financial conditions. So back to Nigeria, what do I expect? Well, we expect that the central bank, we expect that it's likely that the Monetary Policy Committee would hold all interest rates, all monetary policy parameters unchanged at this meeting. However, some other analysts still forecast that, I would see a 50 basis point increase in monetary policy rates, given, and they argue that inflation is still high, at 21.3%, and what else? And they're trying to bring it down because inflation is high and it's still more than double the central bank's upper bound. But we think that the softening of inflation in December, coming from a 17-year high in November, and after it that increased consistently for 10 months, I think that would give the central bank some form of succor. Also, globally, we are seeing inflation begin to decelerate. And as a result of that, we are seeing also some central banks begin to not pause their hiking cycle, but begin to slower the pace of increasing monetary policy rate. Also, if you look at Nigeria, the past 4 monetary policy meetings, we saw consistent rate increase, which is one of the most aggressive we've seen in many, many years. As a matter of fact, last year, the central bank increased monetary policy rate by around 500 basis points, with the most recent one in November increasing by 100 basis points. So I think the central bank will want to pause a little bit at this meeting to kind of let the effect of the previous hikes in monetary policy parameters filter through the economy.
And talking about that inflation tapering month on month, do you think would you say inflation has peaked at this point? And obviously, we had the cues in December. People were buying PMS at crazy prices, and I'm sure that's supposed to play into the inflation data. Or do we expect some kind of lag effect for that?
Yes. So essentially, I'll say it is too soon to say whether inflation has peaked or not. I mean, for the past 10 months, we saw inflation rising consistently up until, I think, 21.47% in November, and then it eased marginally in December. So I think it's a bit too soon to say, oh, inflation has peaked. Also, you said the inflation fuel queues in December were quite a lot, and that's going to play into inflation numbers for January. Even up until January, I'm hearing that there's still a lot of fuel queues. In fact, I just saw the headlines this morning that diesel prices increased around 189% in 2022, with diesel being as high as 850 naira per liter in January. So I think we might still see some uptick in inflation. Also note that even though the inflation numbers for December decelerated, core inflation, which is simply headline inflation less seasonality, inched upwards, which indicates that some of the key drivers of inflation are still very, very much present.
Exactly. And obviously, we have the U.S. Fed. They're having their meeting at the end of the month into February. Obviously, you know, the debates out there, they're going to be hawkish or dovish, but it seems dovish is the consensus at this time.
It's quite interesting, like you said that, like you mentioned, there is a debate between market economists and, you know, U.S. Fed officials. So the market economists think that, you know, the market conditions support a more dovish stance. We've seen inflation, for instance, in the US decelerate consistently for around 6 months, with the most recent one being a deceleration to 6.5% in December. So market economists expect that, you know, US interest rates would not increase much more than the current levels of 4.5%. But some Fed officials still expect, you know, some more tightening, and they see interest rates peaking at around above 5%. So there's this debate. But overall, I think the consensus is that the market conditions support slowing the pace of increases. So we are expecting that instead of 50 basis points increase or 75 basis points increases that we have seen last year, we expect that this meeting a softer increase, around 25 basis points in the US. And other central banks too are likely going to take a cue from that. For example, the Bank of England in its next meeting is expected to increase interest rate by around 50 basis points, as well as the ECB. But I think going forward, we are likely to see a slower pace of increases. But one thing is clear, Ladi, that even though we are seeing inflation decelerate, it is still a far cry from the long-run inflation target of 2%. At 6.5%, US inflation is still significantly higher than, you know, the long-run target inflation of 2%. So monetary policy would need to be restrictive for longer to be able to really bring inflation under control. In addition to all of this, Ladi, we are also seeing some economists that are believe that maybe that some of the factors driving inflation lower is that supply bottlenecks are easing rather than only the effect of monetary policy. So there's all of these factors playing at the moment. But one thing is clear, like the monetary policy needs to be restrictive for longer in order to bring inflation down more substantially.
Because when I look at the central banks, global central banks and their targets, you know, for inflation, it seems, you know, so far away, and it seems like a really painful process, you know, to actually get to those targets. But now we've seen, switching over to the oil markets, now we're seeing some, you know, there's still volatility in that market, but natural gas prices, it broke a key level below that $3 mark. Quite interesting.
Interesting. So you asked two questions in there. So let me start with the first one, oil prices. So at the moment, two big factors driving oil prices. Number one is China. Number two is Russia. So in terms of China, like two weeks ago, China opened up its economy. They just threw away, you know, that zero COVID policy. And we've seen some economic activity. We've seen some more travel. We've seen demand. And you know, the market is quite excited that, you know, this opening of China is going to increase, first of all, demand for oil within the country, but also use demand for oil within the country, but also demand globally more imports, because China, like I've always said, China is the second largest importer of crude oil globally and the second largest user of crude oil. So there's that optimism. Even the International Energy Association, IEA, forecast that China's reopening will have some big effect on oil demand going forward in 2023. On the other hand, we have Russia. And what is going on with Russia? The idea is simply the price caps of Russia, the price caps imposed on Russia by the G7, the EU, is going to take effect, is beginning to take effect. So we are likely to see some supply restrictions coming out from Russia due to the price cap. So these factors are likely to push prices, keep oil prices elevated in the near term. Some analysts forecast that we're likely to see $100 oil again, or that oil prices are likely to range between $90 to $100 in the near term.
Obviously, I know risk investors want to see these prices, still going down so they can enjoy the gains in those other risk assets at this time. But thank you so much, Dr. Adesola Sumoni. That's a head and senior analyst there at Financial Derivatives Company. Thank you so much. Thank you.
Thank you for having me.
All right. Got a little tongue twist there.